Hello students. Today we are going to learn chapter 4, that is theory of firm under perfect competition, microeconomics. First, let's understand what is firm. A firm is a group of people with production tools located in some premises who work with all the raw materials and goods and services which can be sold into the market. Can also be defined as a business unit which owns, controls, and manages a plant or plants, where plant refers to the technical unit. So when we say firm, it could be commercial firms, it could be industrial firms, and it could be financial firms. Now, when we talk about commercial firms, we are talking about the whole chain, that is retailer, wholesaler, or any large commercial organization. And when we talk about industrial firms, these are involved into production of goods. Like think of a workshop or a plant or a factory unit. And when we talk about financial firms, it means all the financial service providers like banks, insurance companies, mutual funds. So in short, a firm is a group of people with all the factors of production who are ready to give some kind of goods or services and sell them to the end consumer. Then what do industry refers to? The firm and the industry are two different entities, but they are correlated. Like let's say, for example, an industry is the name given to certain type of manufacturing or retailing environment. For example, we have retail industry is the industry that involves everything from clothes to computers. So we can say that if KFC is an individual firm, but all the fast food restaurant would fall into the category of industry. So a group of firms producing a homogeneous product is called industry. And conversely, we can say a firm is the company that operates within the industry to create that product. Now, in this chapter, we are going to learn about perfect competition. So, we need to understand what is perfect competition. When we say perfect competition, it involves many buyers and many sellers, which means there are large number of buyers and large number of sellers which are selling homogeneous products into the market. So well-informed producers and consumers, and they know all the information, or they have all the information about the market. So when we talk about the features of perfect competition, these kind of market have more number of buyers and more number of sellers, which are selling homogeneous product. When we say homogeneous product, it means they are selling identical products, be it shape, size, structure, texture, even the name and the price are same or identical. And that is why we say that they are producing homogeneous product. And only one price of the commodity is prevailing in the whole market because they are price takers. Because of the substitutes, or we can say that because of identical products, the different sellers cannot charge differently because of its homogeneous nature. So they are price takers, and there is free entry and free exit to such kind of producers or consumers. So price of a commodity, as I said, is determined by the industry, and at the determined price, all the firms can sell any number of units of the commodity. Now, when we talk about average revenue and marginal revenue curve under perfect competition, before moving on to this, we need to understand as to what is TR, AR, and MR. That is, what is total revenue, average revenue, and marginal revenue. Total revenue is the total amount of income which is earned by a firm by selling the output. So total revenue means the total income which is earned by the firm by selling the commodities. And when we talk about average revenue, it is the per unit earned by the company. And when we say marginal revenue, it means the change in total revenue due to one more additional unit of commodity sold. Like, let's say, for example, if one particular company X had, is selling one pen and earning 10 rupees. By selling two pen, they are earning 20 rupees. By selling three pen, they are earning 30 rupees. So each time the total revenue is changing from 10 to 20, 20 to 30. So there is a change in total revenue due to one more additional unit of commodities sold. And that is known as marginal revenue. Now let's understand what is AR and MR curve under perfect competition. So AR and MR curve under perfect competition becomes equal to demand curve, and it would be horizontal line or parallel to X axis as we can see in the diagram. And the curve simply implies that the firm under perfect competition can sell as much quantity as it likes at the given price determined by the industry, which means that it is perfectly elastic market. Now, let's understand the meaning of firm equilibrium. Equilibrium means a state of rest from which there is no net tendency to move. So the firm's equilibrium means the level of output where the firm is maximizing its profit and has no tendency to change its output. So in this situation, either the firm will be earning maximum profit or incurring minimum loss. So it refers to profit maximization. This equilibrium point is the point where the firm is earning maximum profit or the minimum losses. So they would not like to move from that equilibrium point, because that is the safest equilibrium point wherein the firm can earn maximum profit. So in other words of Hansen, we can say that a firm will be in equilibrium when it is of no advantage to increase or decrease its output. But there are certain necessary conditions for the firm equilibrium. So profit of a firm is equal to the difference between its total revenue and total cost. If I want to know that what is the profit of my company, it's very simple, TR minus TC. That is the total revenue earned by the firm and total cost incurred by the firm. So the difference between both will give us profit. So marginal cost should be equal to marginal revenue, which is the first necessary condition for the firm's equilibrium, where your marginal cost should be equal to your marginal revenue. Now, equality of these MR and MC is necessary but not sufficient. So the sufficient condition is that our marginal cost curve should cut MR curve from below and not from above. So no firm has an incentive to change its behavior. We can see that in the diagram wherein our marginal cost curve is cutting AR and MR from below and then moving ahead. So there are 2 points at which MR is equal to AR is equal to MC, but at both the points, the firm can't be in equilibrium or can't have maximum profit. So as I said before, as a sufficient condition for the equilibrium, marginal cost curve should always cut the MR curve from below, that is point A in the diagram. Now let's see firm's equilibrium under perfect competition. It can be into 2 time periods. And as a matter of fact, The price of good is determined at a point where its demand is equal to supply. And so further, it depends on the time taken by the demand and supply to adjust themselves. So this time element is playing a vital role in determination of price of the goods. So if the period is short, price determination will be influenced more by demand. And if the period is long, then it will be influenced more by the supply. Because in the short run and in the long run, like let's say if it's a long run production, then all the factors becomes variable. Whereas in the short period or a short time period, we cannot make changes into the more changes into factors of production. So the two periods which we are going to study in the next part is short and long period. Thank you.